Over the last year, HMRC sent out more than 357,000 letters to ordinary UK savers. Not to businesses, not to wealthy investors, to people with savings accounts. People with money sitting quietly in the bank, earning a bit of interest. Most of those letters were about one thing: savings interest. If you haven't received one yet, that doesn't mean you're in the clear. It just means yours might still be coming. Here's what makes this confusing. Say you have £60,000 in a savings account earning 5%. That's £3,000 a year in interest. It doesn't feel like much. You've already paid tax on the money you saved. So why is HMRC writing to you about it? Add the full state pension, which is roughly £11,500 a year, and your total income for the year comes to £14,500. That's nearly £2,000 above the personal allowance of £12,570. And suddenly, HMRC sees a taxable figure where you thought there was nothing to tax. This is the moment most people get confused. They think the letter is a mistake, or they think they've done something wrong. They haven't. But here's what those letters don't explain. There are legitimate allowances that could reduce your tax bill to zero, and most pensioners with only the state pension qualify for them without knowing it. That's the first thing we need to clear up. If you want to understand exactly where you stand with savings tax, subscribe now. We'll go through the numbers clearly, no jargon. Let's start with the rule itself, because there's a lot of confusion about what it actually says. Since 2022, banks and building societies have been required to report all interest payments directly to HMRC. Not annually, automatically. Every year, HMRC already has a list of what your accounts earned. So if you think this is about something you did wrong, it isn't. The system changed. HMRC now knows your interest figures before you do. The £10,000 threshold is a separate matter. If your total savings interest in a tax year exceeds £10,000, HMRC requires you to register for self-assessment and file a tax return. That part is the reporting rule. Most people hear £10,000 interest rule and assume it means you need £200,000 or £250,000 in savings before it affects you. That's the first misunderstanding. At today's rates, the numbers work differently. If you have £100,000 in a savings account earning 5%, that's £5,000 in interest, well below the £10,000 self-assessment trigger. But here's where it gets more complicated. Even if your interest doesn't reach £10,000, you can still owe tax on it. The trigger for owing tax is much lower than the trigger for filing a return. Here's a simple example. State pension, £11,500, small private pension, £4,000, savings interest, £3,000, total income, £18,500. Your personal allowance is £12,570. That leaves £5,930 above the allowance. After your personal savings allowance of £1,000 for basic rate taxpayers, £4,930 of that is taxable. At 20%, that's a tax bill of £986 on £3,000 of interest that felt like just a bit extra. In 2023-24, 1.2 million people were newly brought into self-assessment because of savings interest. That's not a small group. These are ordinary savers who didn't change anything. They just happened to be saving at a time when interest rates rose sharply after years near zero. If you've been paying income tax for 40 years and you suddenly get a letter asking you to file a return, it doesn't mean you're under investigation. It means the interest rate environment shifted and the system is catching up. The real trap isn't the tax. The tax itself might be quite small. The trap is not knowing about it. Getting a late filing penalty of £100, then daily penalties of £10 a day for up to 90 days if you ignore it, plus interest on the unpaid amount. That adds up fast on a fixed income. But there's another side to this that most people miss. There's a little used allowance in the tax code that could reduce your interest tax to zero. It's called the starting rate for savings. And the irony is that the pensioners most likely to be affected by these HMRC letters are often exactly the people who qualify for it. We'll look at that next. I used to think interest on savings was double taxation. I even said so at a dinner party once. The logic seemed obvious. You earn money, pay tax on it, save what's left, and then HMRC comes back for another bite when the savings earn interest. Feels wrong, but it isn't double taxation. And once I actually read through how HMRC categorizes income, the distinction became clear. Think of it this way. Your original savings are the tree. You grew that tree from after-tax income. HMRC has already taken its share of the seed. But the interest your savings generate, the fruit, is new income. It didn't exist before. HMRC taxes the fruit, not the tree. The capital you saved is never taxed again. That's the mechanism. It matters because it's what the whole tax structure is built on. Now here's the part that changes the picture for a lot of pensioners. There's a little-known allowance called the starting rate for savings. It allows you to earn up to £5,000 of savings interest completely tax-free, but only if your other income is below a certain threshold. For 2025-26, that threshold is £17,570. Your other income means everything except savings interest, state pension, private pension, employment income, rental income. If your total from those sources stays below £17,570, you can earn up to £5,000 in savings interest without paying a penny of tax on it. This stacks on top of your personal allowance of £12,570. Let's put numbers to it. Say you receive the full state pension, which is £11,500. That's your only income apart from savings. Your other income is £11,500, which is below both the personal allowance of £12,570 and the starting rate threshold of £17,570. So if your savings earn £3,000 in interest this year, your total tax on that interest is zero, not reduced, zero. The starting rate doesn't phase in gradually when you're that far below the threshold. You get the full £5,000 worth of headroom. Now think back to what we covered earlier. You thought you needed £250,000 in savings before this rule would touch you. But we showed that £60,000 at 5% is enough to push a basic rate taxpayer over their personal allowance when combined with the state pension. That's the uncomfortable truth about the current rate environment. Here's the flip side. If your income is modest, state pension only, or state pension plus a small occupational pension, there's a very good chance the starting rate covers you entirely. You might be receiving HMRC letters about interest you owe no tax on. Where the picture changes is when your other income climbs above that £17,570 mark. Once your non-savings income exceeds the starting rate threshold, the £5,000 allowance starts to shrink. For every pound of other income above £17,570, you lose £1 of starting rate headroom. By the time your other income reaches £17,570, the starting rate has gone. Then you're relying only on your personal savings allowance of £1,000, and beyond that, interest becomes fully taxable. That's the line we need to stress test. What happens when income creeps up? That's where we go next. Let's look at two people in a very similar situation and see how they end up in very different places. Alan has £100,000 in a savings account earning 5%. That gives him £5,000 in interest. He receives the full state pension of £11,500, his only other income. That puts his total income at £16,500. His state pension of £11,500 is below the personal allowance of £12,570, so it uses none of the personal allowance. That means his full £5,000 starting rate for savings is intact, plus his personal savings allowance of £1,000 on top. Total tax-free interest, £6,000. His actual interest is £5,000. He owes nothing. But Alan doesn't know that. When the HMRC letter arrives, he panics. He calls a high street accountant who charges him £200 to file a simple self-assessment return. The result, he owes no tax. but it cost him £200 and several weeks of worry to confirm what he could have worked out himself. Brenda has the same savings and the same state pension. She spends an afternoon on the HMRC website, understands her position, and files online herself. She owes nothing. She also moves £20,000 of her savings into a cash ISA, sheltered from tax in future years. Same income, same tax result. Completely different experience, according to a witch. Survey, a straightforward self-assessment return from a high street accountant in 2025 costs between £150 and £250. For someone who owes zero tax, that's a purely avoidable cost, driven entirely by not knowing the rules. The real cost is not financial, it's the loss of control. When you don't understand your position, you hand decisions to others. Sometimes that's necessary. With savings tax, it often isn't. The fragility path: ignore the letters, don't engage with the numbers, react only when forced to, and pay for help with decisions you could handle yourself. The resilience path: understand your allowances, know where your income sits, file online if needed, and gradually move savings into ISAs to reduce future exposure. Brenda isn't a financial expert. She just took one afternoon, and the starting rate for savings, once you know it exists, is not difficult to understand. There's one more scenario worth thinking about. What happens if interest rates fall? Does that simplify things, or does it create a different problem? That's next. Interest rates in the UK have been unusually high by recent historical standards. But they won't stay here forever. A Reuters poll from March 2026 showed the median forecast for the Bank of England base rate settling around 3.5% by the end of 2026. What does that mean in practice? If rates fall from 5% to around 3%, the same £100,000 in savings goes from earning £5,000 a year to earning £3,000. For some people, that actually reduces their tax exposure. Less interest means fewer worries about crossing thresholds. But for others, depending on how their savings are structured, it creates a different problem. Take someone with £100,000 in a standard savings account and a modest private pension of £4,000 a year. At 5%, they earn £5,000 in interest. Their total other income is £15,500, which eats into their starting rate band and leaves some interest taxable. At 3%, they earn £3,000 in interest. Their other income is still £15,500. Their personal allowance is £12,570, so taxable non-savings income is £2,930. Starting rate remaining: £5,000 minus £2,930 equals £2,070. Interest of £3,000 minus starting rate £2,070 minus personal savings allowance £1,000 leaves nothing taxable. A rate fall actually eliminates their tax bill entirely. Now take someone who moved £20,000 per year into a cash ISA for 5 years. They've sheltered £100,000 from tax entirely. Their taxable savings account is down to zero. Interest from ISAs does not count as taxable income. No HMRC letters, no self-assessment, no anxiety. That's the difference between reactive and proactive positioning. A rate drop doesn't automatically solve the problem. It depends on the shape of your income. What it does remind you is that the tax picture changes every year, and a strategy that worked at 5% might need adjusting at 3%. That said, the numbers are only half the story. Because even for people who understand the maths, there's often a psychological barrier that stops them acting. That's worth talking about. I received one of those HMRC letters myself a couple of years ago. I remember the feeling, not guilt exactly, but something like dread, the sense that this was going to be complicated and I was probably already late. I logged in, and HMRC had already populated my interest figures from the bank. They knew the numbers. They just needed me to confirm them. It took about 15 minutes. I tell you that not to make myself sound efficient, but because I genuinely didn't expect it to be that straightforward. And I've spoken to plenty of people who assumed it would take hours, or that they'd need a professional to handle it. There are two things that stop people from engaging with self-assessment. The first is shame. The sense that I'm 62 and I've never filled in a tax return, I shouldn't have to start now. That's a reasonable feeling, but it doesn't reflect the reality of what HMRC actually expects from you in this situation. Most savings interest returns are simple. The data is already there. The second barrier is avoidance. The hope that if you leave it long enough, the letter goes away. It doesn't. It turns into a second letter, then a penalty, then interest on the penalty. The system doesn't punish you for not knowing, but it does penalize you for not responding. Here's the shift that makes the biggest difference. Register for self-assessment before the letter arrives. Not after. Before. You can do it online through gov.uk in about 15 minutes. Then when the letter comes, you already have a login, and the process is far less overwhelming. If HMRC already writes to you about your savings interest, the register first approach means you're working with the system rather than catching up to it. The embarrassment of not knowing how to file is entirely understandable. The process was designed to be administered by payroll departments, not individuals. But for savings interest, the return is much simpler than you might imagine. And once you've done it once, the mystery goes. Let me now walk you through the practical steps, the 4 things you actually need to do. Here are the 4 steps that actually matter. None of them require an accountant. None of them are complicated. But you do need to do them in order. Step 1. Find out how much savings interest you earned in the last tax year. Log into each of your bank and building society accounts and look at the annual statement or interest summary. Most accounts send a year-end summary automatically, but you can also request one. If you have joint accounts, your share is 50% of the total interest. Add everything up. Step 2. Calculate your total other income. That means state pension, any private or workplace pension, part-time earnings, rental income, everything that is not savings interest. Look at your P60 if you have one, or your pension provider letters. Write the total down. Then compare it to £17,570. If your other income is below that figure, you likely qualify for some or all of the starting rate for savings. If it's below £12,570, you qualify for the full £5,000 starting rate, plus your £1,000 personal savings allowance. Step 3. If your total income including interest exceeds your personal allowance and your interest exceeds your available allowances, you need to file a self-assessment return. The deadline is the 31st of October for paper returns and the 31st of January for online returns. Register at gov.uk if you're not already registered. The process pre-populates a lot of the data HMRC already holds. Step 4. To reduce future exposure, use your ISA allowance. For 2026-27, that's £20,000 per year per person. If you have a spouse or civil partner, they have their own £20,000 allowance. A cash ISA works like any savings account, but the interest is completely tax-free and does not count towards any threshold. You don't need to do this all at once. Moving £20,000 per year over several years gradually shifts your taxable savings balance down. If you have £300,000 in savings, it would take 15 years to shelter everything through ISAs alone. That's not a reason not to start. It's a reason to start now rather than later. Even partially sheltered savings reduce your future tax exposure and reduce the number of returns you need to file. One more thing on the ISA point. Premium bonds also generate tax-free returns. Winnings are not subject to income tax. And if you're married, a spouse with a lower income may qualify for more starting rate headroom than you, making it worth considering putting savings in their name. If you want a full video on structuring savings across ISAs and which account types suit which income levels, leave a comment and we'll make it. And if you're new here, subscribe. This is exactly the kind of decision we cover regularly for people approaching or in retirement. Let's bring this back to where we started. HMRC is not coming for your savings. The £10,000 rule is not a new tax. It's a reporting requirement, a threshold that triggers a need to file a return, not a bill. And for most pensioners with modest incomes, The starting rate for savings and the personal savings allowance together cover the interest entirely. The real risk is not the tax itself. It's the combination of not knowing your allowances, ignoring letters until they become penalties, and paying for professional help you don't need. You've worked for this money. You've paid tax on it already. Understanding how the interest side of it works is not complicated. It just requires someone to explain it without the jargon. That's what we try to do here. Your allowances are real. The starting rate is real. The rules are not designed against you. They just need to be read. If you have a question about where your savings sit relative to these thresholds, drop it in the comments. We read everyone and use them to plan future videos. There are probably other people watching who have exactly the same question. Stay calm, know your allowances, and keep that money working for you. I'll see you in the next video.